Hello everyone and welcome to this video on how to successfully plan your child's financial future. My name is Evan Frazier and I'm a financial planner with over a decade of experience in the industry. Today we're going to discuss some of the traditional ways of paying for college and one new twist on an old idea that allows some flexibility and tax-free growth around your planning. Option 1. Most people will think about student loans, grants, or scholarships. One of the pros of getting either a grant or a scholarship is that they don't have to be paid back. It's just your money, and once it's been used for what the grant says it can be used for, you're done. Subsidized loans are nice because the interest is paid by the government while you're enrolled for at least part-time until you get out of school. With the loans, you might also qualify for loan forgiveness. I know that's kind of a touchy political subject right now. It may happen, it may not, but it's not something that I would necessarily plan for and bet my future on with that. The cons of that traditional approach is the student loans can be very expensive and the interest tends to compound. It's very difficult for a child to start their life out when they're already in debt. A lot of people may not know this, but student loans are backed by the federal government, which means that they cannot be discharged in bankruptcy. So one of the things I always recommend for my clients around any type of loans, but especially student loans, is we do not co-sign loans for our kids. It doesn't matter that the kids might have the best of intentions on paying it back. It may not be up to them. And I'll give you a very sad story that actually happened that kind of highlights this. There's a young lady going to school. She had actually finished her undergrad. She was studying to be a doctor. She was halfway through medical school. Her parents said, yep, she's going to make a lot of money as a doctor. She's very bright. She's absolutely going to be able to pay us back. So they co-signed her student loans. After Thanksgiving one year, she was driving back to school, got into a car wreck, and died. Now there is no possible way that she is ever going to pay those student loans back. And if she was the only one that had signed for them, the loan company would be out of luck, the federal government would pay the loan company back, and everybody would go away. However, in this situation, because the parents have co-signed for this loan, they're going to have to pay back those student loans until they pass away. They're not actually ever going to be able to pay those loans back because they don't make enough money. And it's going to get to a point where their Social Security checks are going to be garnished come future time. Again, it doesn't matter how nice the person is, how willing the child is to pay you back. It just may not be up to them. It's just not a good idea to put yourself at that risk. Put the risk back on the loan company, not on yourself. Okay. The other side of this would be so devastating to young people starting out with debt. A 2015 Gallup poll found that Americans who graduated from college between 1990 and 2014 and who had borrowed $50,000 or more were less likely to thrive physically, emotionally, or financially than their debt-free peers. The Gallup poll results mirror those of a LendingTree poll in which 65% of respondents claimed to have lost sleep worrying about their student debt, and 70% reported having physical symptoms ranging from headaches and fatigue to muscle tension and shortness of breath. Having that noose hanging around your neck when you're just trying to get out and get started in life, which is already difficult enough, can be very difficult. It's, I think, very different from when most of us have grown up. College was not nearly as expensive. You could get part-time jobs to pay for it. That just frankly is no longer the situation anymore, okay, unfortunately. The other area of people's lives that they don't think about that this touches for these children is getting married and starting families. The median age for marriage is now 27 for women and 29 for men, while in 1960 was 20 and 23 respectively. The odds of a woman marrying in the first 4 years after graduating from college decreases by 2% per month for every $1,000 of student debt that she incurs. Furthermore, because women attend college at higher rates than men, and because they are more likely than men to pursue graduate degrees, they leave school with more debt. 42% of women and only 27% of men have more than $38,000 in college debt. Starting out life with that much debt means that you have to delay many other things. You have to delay starting up a business, starting a family, having children, all things that are very good things that we want for our kids. Very difficult to do when you have lots of that debt. The father of 3 girls and a boy, the best thing I feel I can do for my children is to give them a chance to start out their life debt-free. Option number 2 for paying for college, stock market investments. Okay, basically going out, buying stocks, bonds, mutual funds, things like that. The pro for this is you've got a potential for very high growth if you're very good at investing. You're also able to use this for any purpose. So if you wanted to use it to buy a car for them to drive to school with, or if you wanted to use it to help them start up a business or something like that, you have a lot of flexibility and you can use those funds. Or if you wanted to keep the funds for yourself, then you could keep the funds for yourself. With that kind of flexibility, if there are no rules around it, you can do with it as you please. The downside to this approach is a few things. One, you also have the potential for higher losses. You have a real shot at having a bad year and having a lot of that wealth wiped out. You're also going to have to pay taxes on that money, okay? And it's not just when you go to sell it, but if it's paying dividends and things like that, then you've got to worry about those taxes dragging on the portfolio while you're waiting to spend it, okay? This can also count against financial aid. They're going to look at the different assets that use the parents, grandparents, anybody that is going to be giving money to the kid. Those are going to be taken into consideration when looking at scholarships and financial aid. Okay. Another traditional option approach is using something called a 529 or Coverdell accounts. Those are 2 types of accounts that the government set aside that says, look, if you put money into these and use them for educational purposes, you can avoid paying any federal income tax on the growth of those investments. Now, some of the states will also waive state taxes, and some states may even give you a state tax deduction for putting money into these types of plans. You'll have to look at the state-by-state basis depending on where you live. Okay. One of the other pros of using these types of accounts is that the 529s can be transferred among family members without penalties. So let's say if you have 2 kids and the oldest one gets a full-ride athletic scholarship or some type of other scholarship, great. We can just pass that 529 down to the next child. So we have a little bit of flexibility with being able to pass assets tax-free between family members. Okay. The downside to these types of accounts is that they are still subject to market risk. They're invested in the stock market, and they can go up and down just like with the stock market. Okay. If you do not use these for college tuition, you can lose your tax-free growth on the portfolio, and you might even incur penalties. Okay. And so that's one of the things that has to be used for college tuition. There are rules around it. You may not be able to use it for things like room and board or buying car to drive to class or things like that. There's a lot of restrictions around what the money can be spent on with these types of accounts. Very limited investment options. There's also typically limits on the amount you can contribute into these types of portfolios. And lastly, they also count against financial aid just like regular stock market investing does. Okay. Now, there are some specialized types of 529s that are called prepaid tuition. Okay, so they basically allowed you to buy credits today at today's dollars, no matter how much tuition might go up in the future. Okay, these credits can only be used for tuition; they cannot be used for room and board. They are nice that they're typically state-sponsored. Not every state has them, but I think about 9 of them do right now. They typically have higher contribution limits than what the 529s will allow for. And there's no market risk. Doesn't matter what the stock market does, you've already paid for a certain amount of credits. Okay. Downside of these is that you are, unlike the 529s, you are restricted to an in-state participating college. If you're going to go out of state or a private school, they'll give you your money back from the original investment, but will keep none of the growth. And so as college prices go up, you won't be able to buy in at those lower prices for those out-of-state schools anymore. Okay. Another option that I will touch on briefly, it's one that we never recommend, but I want to make sure people know that it is an option of last resort. IRAs, or individual retirement accounts, can be used to pay for qualified educational costs. The rules for these are very complicated for getting an exception on these. So make sure that if you do go down this road, you're going to need a CPA specialist that understands not just normal CPA stuff, but understands specialized education planning to stay within those guidelines. Be very difficult. If not done right, it can cause the entire distribution to become taxable. We really just, because of how complicated that is, we don't recommend using the IRAs for those. Okay. I want to pause here because I want to talk about what can really go wrong with those types of investments that are involved within the market. I have a friend named Liz. Growing up, Liz started college in 2008. Her parents had done diligently investing to a 529 for most of her life and had a good amount saved up. However, they had not paid attention, and they had not actually reduced the risk of the 529 as Liz got closer to her college start date. And what happened is, we all know, in 2008, the market crashed, and the value of her 529 dropped 40%. 40%. Had they been moving to a more conservative portfolio that would not have dropped like that, Liz would have had all of her college paid for. As it stands now, Liz is 35 and still paying student loans because the accounts dropped so badly that she was not able to pay for all of college. This is a very difficult thing for any one of those strategies that have market risk attached to them. Now, here's the thing. We can't just sit in cash because we have risks the other way, right? So inflation is probably a hot topic of just regular inflation. Education inflation is typically double what regular inflation is. So long-term average inflation is around 3%. Long-term college inflation is around 6%, which means if I just put $100 into that account, every year I'm losing $6 out of that account. Okay? So we have to make sure that we have something that is going to grow to beat education inflation, but also doesn't put us at market risk, where if the market crashes in the year that our child needs to go to college, we're not telling the child, hey, you're going to have to take some time off before you can go to college and wait for this to come back. Or, hey, we can pull it out now, but you're going to have to take student loans. Neither of those are options that we want to saddle with an 18-year-old just getting started in life. So, what is our more flexible option? Okay. A lot of you may have heard of a term called infinite banking. We're going to use kind of a form of that. It's an indexed universal life policy that allows us to save money tax-free, but we can use it for whatever purpose we want. Okay, so it allows us to make monthly contributions just like we would to like a 529. It will grow tied to an index. Index is just a fancy word for a measurement of stocks. So the S&P 500 is probably the most famous index most people have heard of. Okay, so basically what it's going to say is that in a year, if the index goes up 10%, the policy will go up 10% with it. If the index goes negative and loses money, there's a floor built in, and your money will never drop below where it started. So if I have $1,000 in the portfolio and the market goes up 10%, now I have 1,100. If the next year the market goes down 10%, I just stay at $1,100. I'll never go back below 1,100. And each year it's going to reset, and that's my new mark, and I'll never go below that new mark. So it takes out all of the risk of what happens if my child needs to go to college in the year that we have a major market recession. It's completely eliminated that risk while still giving us upside potential on that. Now, because we're bearing this inside of a life insurance policy, the favorable tax rules for that allow us to take the money out of the life insurance policy tax-free. Doesn't matter whether we use that money to put a down payment on a house and have the child live there during college and then rent it out to their buddies and then sell the house for a profit when college is over. Doesn't matter if we want to use it for buying a car so that they can drive to class. It also doesn't matter if they decide, you know what, Dad, I don't want to go to college. I want to take a coding boot camp, or I want to start up plumbing or electrical business within the trades, and I just need, to get some tools and get startup capital for that. Or maybe we've gotten a scholarship and college has been all paid for. Now we've got this money sitting in the back. When they're ready to put a down payment on a house, they can then use that on the house. One of the other benefits with this is that even after we've used that to pay it, it will continue to grow, and they can leave that or add to it later on as part of a retirement policy, and they will be able to pull money back out again in the future for whatever they want, retirement or their kids' college, all tax-free because of the way the rules around these policies work. They are extremely flexible. They allow us to do a lot of myriad of things that traditional 529s and other types of planning do not allow us to do. Okay? If you would like to learn more about this process, what it would take to get started for your kid, what an amount would look like and what that would look like by the time they're 18 or 25 or however you want to schedule these gifts for them, then please set an appointment. You'll see a link here at the end of the webinar that you can click on to set time on my calendar. I'll be happy to take 15 to 20 minutes, gather the information, and then give you a